Welcome to GRE. I'm your host, Keith Weinhold. Historically, just how often do national home prices fall and what causes it? Then learn more about how today's housing affordability is absolutely awful. Then our informative live real estate event that you're invited to join, all today on Get Rich Education.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Pennsylvania's Monongahela River to Mono Lake, California, and across 188 nations worldwide. I'm Keith Weinhold, and you are listening to our one big weekly show. This is Get Rich Education. Real estate never goes down. Yeah, a handful of people actually told me those 5 exact words in the mid-2000s decade. They said, real estate never goes down. Of course, 2008's global financial crisis and mortgage meltdown proved them all wrong. And you know what? I have never heard one single person utter that sentence since. Late last year, national home prices took just a small dip for a few months on a month-over-month basis. That's not something that often happens, though. So as minor as that was, that's the event that actually precipitated the creation of this segment of our episode here. There's a colorful chart that provides this terrific visual of the month-over-month shifts in U.S. home prices per Case Shiller dating back to 1975, okay? And if you're one of our Don't Quit Your Daydream letter subscribers, you got to see it last week. Winston Churchill said, the further backward you can look, the further forward you can see. I don't know that I've contributed anything quite that proverbial to the world on that exact subject yet. I just say that when it comes to future expectations, I favor looking at history over hunches. So before we look at why home prices historically fall, first of all, why go back to 1975 when we're looking at a history of home prices? Why that slice of time? 1975 up here to the present. Well, that's almost 50 years. It's 2 generations, so it stops just short of your grandfather's generation, which was back when the dollar was still pegged to gold. So here's what we can learn from almost 50 years of home price history on a relatively untethered dollar. Nominal home prices usually rise, but not always. And this is not inflation adjusted, okay? Now, of the 500 to 600 little rectangles, because that's how many months there have been since 1975, they're nearly all blue, which means that prices rose. But before we center on the red areas, which is when and where prices dipped, the next thing I can tell you is that it shows that home prices are remarkably stable. That is another historic takeaway. Also, a seasonal fluctuation is quite apparent. Year after year, home price growth is weaker in winter and stronger in summer. But do you know how many times national home prices have dipped since 1975? Any idea? The answer is 3. 3 periods of falling prices in the last 48 years. Those periods were the erstwhile global financial crisis period from 2007 to 2011, and then that tiny dip that occurred in the last few months of last year. That one was due to a late pandemic slowdown. Before I tell you about the other time, that third time that so few really discuss, let me tell you, the 2008 GFC, that went deep red. I mean, most markets had losses of 20% or more, and I was an active real estate investor at that time, and that downturn was caused by irresponsible lending, rampant speculation, and an oversupply of housing. You might know all that. That's well documented. Now, take that and look around today. We don't have any of those conditions because today it's tough lending standards. It's no wild speculation. And also the opposite condition, it is that stark undersupply of housing like I've talked about so often. But few people seem to know about an earlier attrition in prices, and it was a mild early 1990s downturn. Yeah, now it was really small, just 1% or 2% per year in a lot of places, but it persisted for more than 5 years. I think a lot of people don't know about that small early 90s downturn, and that's why just before the global financial crisis, people said then what we all now know to be false: real estate never goes down. Yes, the start of the 90s. That's before my time. I mean, I was alive, but not old enough to be investing. So I had to do some research here about what caused prices to circle the drain just a little. And to boil it down, it occurred for two main reasons. It was from defaults created by high household debt and also adjustable rate mortgages kicking in, making those homeowners pay higher rates, and some couldn't pay it. So as we look back, like Winston Churchill, to get lessons from history, I like to look at today's landscape and see if we have any of those two early 90s conditions. Do we have high household debt today? Well, rather, really, it's this era's aberration that we have the opposite condition because today households are sitting on lots of cash and equity. And then the second reason for that early 90s price dip that so few talk about is adjustable rate mortgages kicking in. Okay, well, let's look at that today. Today, that is affecting the commercial space and not the residential side, where today's homeowners have now been long accustomed to fixed rate debt. That's what most have. Now, before we look into the future of home prices, and I've got some good stats there. Now, to summarize, the top takeaways from 48 years of looking at monthly home price growth are that prices typically rise, but not always. Prices are remarkably stable. Prices rise more in the summer than in the winter. And that historically, let's distill it down to three chief culprits for falling prices here from looking at history are an oversupply of homes, irresponsible lending, and a distressed borrower. Now, with housing, people tended to use the word uncertainty an awful lot. You know, people have used that word almost constantly ever since the pandemic began in 2020, including me. Now, I think that we can finally say that the clouds have begun to clear. Although, of course, we never have 100% clairvoyance, most everyone is confident that the majority of interest rate increases are done. Inflation has come down. Mortgage rates are just now back at historic norms now, actually, and home prices are rising at historic normal rates again, too. You have all this money sloshing around the economy that is still fueling consumer wealth from the pandemic. So all this money against a low housing supply and with increased economic certainty. And all of that really has a lot of people more bullish on the housing market than I've seen in a couple years. Home builder confidence is really surging right now. And looking into the next year, more and more analysts now forecast increasing national home prices. Fannie Mae recently revised their forecast upward to 3.9% appreciation. That's for this calendar year. CoreLogic now expects 4.3% higher prices from June of this year to June of next year, and Zillow expects 6.3% price appreciation over that same time period. And our core investor areas here at GRE, they have just kept climbing, and they really didn't participate in late last year's slowdown at all. And I guess this is not necessarily good news, right? I mean, the bad news might be that there is no price break, but, higher rates still didn't break the market. Now, I've heard some analysts at real estate research firms speculate that if interest rates fall in the next year with all of these other favorable conditions that I talked about, that 10% home price appreciation is possible. Yeah, I really say that that's speculative, all right, because it is so hard to predict future interest rates, and I'm not willing to do it. And like I share with you here, which is contrary to what people used to believe, and a lot of people still do believe, it is that mortgage rates really don't have that much to do with home prices. So when it comes to home prices over the next couple of years, I think that the most common sense expectation is slow price growth and stability. Now, just wait until you see what's happening with the homeownership rate today. I want to share that with you shortly. But before we get back to real estate, let's zoom out for a moment and look at the broader investing landscape. Let's take a breath here while we're here at mid-quarter. Bitcoin is getting less volatile than stocks. That's one trend lately. Another way to say that, though, is that Bitcoin prices are in a period of historic stagnation. Gold has fallen from the $2,000 an ounce mark that it touched recently. Oil prices have been on a multi-month tear. But when you look at oil on an inflation-adjusted basis, which so many people forget to look at it through, oil at under $100 a barrel, that feels inexpensive. Elsewhere in investing, some online savings accounts have hit the 5% yield mark. That might sound good when you consider that inflation has backed off, but as most agree that the CPI is understated, if you think then that the true diminished purchasing power of the dollar is 5% and your savings account rate is 5%, aren't you at least treading water? Well, first of all, just treading water means that you aren't going anywhere or growing, but you're not even treading water because don't forget that your interest earnings on savings accounts gets taxed. Now, it's good to hold some liquidity always, but you're likely underwater with a 5% savings account in this era. Yes, on your interest earnings, you are taxed at your earned income tax rate between 10 and 37%. So let's just say that you are in the 32% tax bracket. Well then, real inflation, if that's 5%, your savings account rate is 5%, but that savings account rate of 5% only yielded 3.4% after you pay that tax. On an inflation-adjusted basis, then, even if you happen to have a savings account with a yield that high, your inflation-adjusted return is a negative 1.6%. That's why here at GRE, we typically invest in vehicles that target returns vastly exceeding both inflation and taxes. You've got to get free of both of those things. Now, as much as that might hurt, you know who today's real estate market is actually really bad for? It is even worse than for the saver that's not treading water. It is downright awful out there for those wannabe first-time home buyers that just can't clear that affordability bar because they are looking at this triple-headed monster of higher prices, higher mortgage rates, and stringent lending requirements. And then if they overcome all of that, they've got to compete for that really tight supply. So it's made affordability for people in that position really awful. In a lot of markets, a starter home is $400K. Well, with your 20% down payment plus the closing costs, that is $100,000 out of pocket right up front, as well as your ongoing monthly payment, all for an asset that doesn't generate income when it's your own home. Well, that is just an insurmountable hurdle for a lot of people. Well, this low affordability, it moves people out of the home buyer class and it adds them to the ranks of the renter class. And well, there is our opportunity as landlords, as rental property investors. Now, you aren't preying on these people. You're risking your capital in order to provide good housing for them. But curiously, the homeownership rate is actually just a touch higher than usual right now, despite this souring affordability. So let's take a look at this, and I'll break down what it means to you, as well as where I think we're headed. Since 1965, right, the average homeownership rate is 65%, and currently it is 66%. So it's running just a little high than its historic average. And by the way, homeownership peaked at 69% in 2004. And oh gosh, 2004, that's back when you could outright lie, document lies on forms about your income, job, and assets, and still get a mortgage. And many people did just that with Ninja loans. And when you hear the acronym Ninja loans, what that stands for is no income, no job, or assets. Well, you either rent your home or you own your home. It's basically one or the other. Well, then what that means is with today's 66% homeownership rate, everyone else, 34% are renters. When the homeownership rate drops, then you've got more renters. The low point for homeownership was in 2016 at 63%, and it's grown since then, again, up to today's 66%. Well, you might wonder, how in the heck is homeownership a little above average today in the face of this low affordability that I was just talking about? Well, there are a few reasons for that, and it's not always intuitive. For one thing, America's population keeps aging, and that skews figures because homeowners tend to be older. And then next, you got to think about incumbents, okay? Those people that already got their home a year ago or more. Well, they have these really low, affordable payments with the low rates they got. Well, they're not going to lose their home and become renters. 80% of borrowers have a mortgage rate under 5%, and you are really happy to stay put when your mortgage rate begins with a 4 or less, and you're able to keep making that lower payment. So that payment amount also does not rise with inflation. And what all of this does is this introduces a lag effect in the stats. It's going to be a little while until this low affordability gets reflected in a lower homeownership rate. There's a low foreclosure rate, under 1%. Americans can afford their payments, and they have the motivation to keep making them because the payment's low. They want to keep that low interest rate, and they've got equity. Now, over on YouTube, I shared a great map with you. Gosh, being a geography guy with real estate, I love real estate maps. I shared the map with you, the homeownership rate by state, breaking it down by state. And join us over there on YouTube. We are called Get Rich Education. Of course, I host that show, and it's different from this show. And what's the trend here when we break down homeownership by state? Well, homeownership is highest in low-cost states like the Midwest and Southeast, and homeownership is lower in high-cost states. So therefore, West Virginia has the highest rate at 78% because it's low cost, and New York has the lowest homeownership rate at 54% because it's high cost. Yes, New York City drags down the number for upstate New York. So where are we headed in the future? I expect a national drop in the homeownership rate. This is because few expect property prices or mortgage rates to fall significantly anytime soon. Lending requirements have been staying strict and should continue to stay strict. So it's the awful first-time homebuyer affordability that's going to continue to take the homeownership rate lower. And see, first-time homebuyers, they are also exactly the type of people that often have student loan debt repayments to make if they ever have to begin repaying them. And that's also going to make it tougher for people to clear that affordability bar. So these people are going to keep being your renter. And that's why I expect the homeownership rate to plummet below 66%, which again, that's where it's at now, and then below the long-term average of 65% by 2025 or 2026. That's where we are likely headed if market forces prevail. Now, depending on who our president is in 2025, government relief programs are just about the only thing that I can see getting in the way of a declining homeownership rate. Household formation is high right now because you have so many Americans between ages 25 and 40. So that question that you've got to ask at this time, when that household is about to be formed, is that new household going to be formed as an owner-occupied residence or as a rental? And increasingly, it is positioned to be a rental because of that continued poor affordability. See, for a ton of people, if they didn't get their ultra-low mortgage rate the past couple years, then it is too late. That is over. That era is done. That's why their affordability ship has sailed. That ship has left the port. That ship has passed. It is gone. And that's why more renters are being made every single day. So if you're a landlord, this is expected to both increase your occupancy rate and the amount of rent that you can charge. Carefully chosen rental property is really where today's opportunity is. And I've got more on that shortly, as I'm about to bring in one of our two investment coaches to learn about how they see today's landscape. And, you're telling us that you find it so helpful to have free one-on-one coaching with them, either Aundrea or Naresh. Both coaches have their MBAs, and when you read their bios on our coaching page, they've got some impressive international experience, corporate experience, but they both live right here in the USA, and they are active real estate investors themselves. That's really how they help get you started and learn your goals and connect you with the right market and property. It's an in-house conversation with an investment coach and I straight ahead, and we'll discuss how we can help you. I'm Keith Weinhold. You're listening to Get Rich Education. I'll just tell you, for the most passive part of my real estate investing, personally, I put my own dollars with Freedom Family Investments because their funds pay me a stream of regular cash flow, and returns are better than a bank savings account, up to 12%. Their minimums are as low as $25K. You don't even need to be accredited for some of them. It's all backed by real estate, and I kind of love how the tax benefit of doing this can offset capital gains and your W-2 job's income. And they've always given me exactly their stated return, paid on time. So it's steady income, no surprises, while I'm sleeping or just doing the things I love. For a little insider tip, I've invested in their Power Fund. To get going on that, text family to 66866. Oh, and this isn't a solicitation. If you want to invest where I do, just go ahead and text family to 66866. GRE listeners can't stop talking about their service from Ridge Lending Group and MLS 42056. They've provided our tribe with more loans than anyone. They're truly a top lender for beginners and veterans. It's where I go to get my own loans for single-family rental property up to fourplexes. So start your pre-qualification and you can chat with President Chaley Ridge personally. They'll even deliver your custom plan for growing your real estate portfolio. Start at ridgelendinggroup.com.
This is our Rich Dad, Poor Dad author, Robert Kiyosaki. Listen to Get Rich Education with Keith Weinhold. Don't quit your daydream.
I'd like to welcome in our own Aundrea Newbern. She's been with us here at GRE for 3+ years. She spent most of that time streamlining our internal operations in order to help bring you a great show each week. But I began to notice after a while that she's also really good with helping investors. So this year she became a GRE investment coach. Aundrea now helps match you one-on-one to the right markets and providers for your own personal investing portfolio. And you can always connect with her there at gremarketplace.com/coach if you don't have a coach yet. Today, she's here to tell us about a special one-time live virtual event where she'll focus on one particular fast-growing market with brand new construction fourplexes. Aundrea, hey, welcome back to the show.
Hey, Keith, so good to be back. Thanks for having me on.
Why don't you talk to us first about, before we talk about this special one-time event in one advantage geography, the broader landscape. Tell us about your rental market overview as you see it here.
So things have been very busy lately, which is great and I think expected. I have been doing a lot of coaching calls with GRE listeners the past couple of months, and we're still seeing things are rocking and rolling. So we're still seeing a lot of cash flowing investment properties that are, of course, getting snapped up very quickly by our listeners. A lot of this is, of course, in the Southeast, the Midwest, where we've historically seen those types of markets. The good thing now is inventory is not always gone the same day it's released, but it's still going quickly. So rather than having to act immediately right now, sometimes you have at least a day or a few days to think about things. The other thing that we're kind of seeing is, prices are remaining stable, but we are still seeing some increases across the board. So I think a lot of people had hoped that prices would fall. We're just not seeing that at the moment, but we're not seeing huge price increases like we were talking about in previous episodes.
Yeah, we've seen this gradual national price increase, pretty much a stabilization of mortgage rates as people continue to get used to really what are historically average mortgage rates, of course. It's good to hear that things are rocking and rolling. I kind of thought that you were more into rap myself, but we'll go with rocking and rolling. It is a pretty vibrant market, and really it isn't nationally because the amount of transactions have been down, but we continue to work with these long-term providers, these relationships that we've had at GRE Marketplace that you're helping people with. People understand still, even in today's environment, it's difficult to make a case that it's better to have a dollar invested anywhere else over the long term. Are we seeing any sort of waiting list situations with any of our providers with the inventory and the interest flow, Aundrea?
We still see some of those. It is not common for every one of our providers to have wait lists, but we do have some that have them at the moment.
Okay, so most providers do not have a wait list.
That's right. Yep, most do not. Most you can get inventory, within just a few weeks or a few days if you need to, but we have a select few that still have that wait list.
Okay, so this is what you're seeing. And then what if GRE followers, which are the people that you're helping coach, and that's a free coaching service, by the way, what have they been interested in or talking about? What are you hearing from them? Where's the demand?
I have gotten the same question from, I would say, probably 75 to 85% of the coaching calls I've had. And a lot of people are struggling right now with the question of, hey, I'm sitting on a lot of equity from my existing portfolio, but I don't want to access it right now because it's locked in at a low interest rate. What should I do and where should I invest if I end up pulling that money out? So I've had a lot of conversations with investors recently about how they're sitting on this equity. They're not doing anything with it. They're obviously not making, the kind of money they could and having the type of net worth that they could if they went ahead and purchased something at the moment. We're still seeing a lot of people interested in the Southeast, like I had mentioned previously. So we're seeing the majority of the money go there into the Midwest, where there are those solid cash flowing properties that are appreciating. But we have to get past that whole conversation about, I don't want to buy things at higher interest rates right now.
Right. Maybe it's my fault a bit, Aundrea. Over the years, I have made people highly aware when you're sitting on a lot of equity, that creates no return. So maybe that creates a bit of frustration in some, but it is in the best way. You have the option of staying put, or maybe if you can find a second mortgage on your non-owner occupied properties, you can keep that first loan in place and access some of the equity. And then the other trade-off is, do I want to go ahead and just sell and reset my leverage ratio at a more advantageous ratio, but yet do that at a higher interest rate? Well, you're going to co-host with the provider a terrific event. Let's talk about this coming Wednesday's live event. That's in just 2 days. It centers on new build income properties in a really fast-growing part of the nation. Tell us about it.
We have a provider that our listeners have been buying from for years, but they have such a good product that the last few years it's been hard to get, your hands on their inventory. So now they actually have some fourplexes, new construction, like Keith mentioned, that can be purchased at this moment, and you should be able to close on those very quickly in this year, early next year. So I do want to talk a little bit about that market and kind of what we're seeing there as far as growth, and then the product itself as well.
Yeah, we're talking about the Intermountain West here. Both pre-pandemic and during the pandemic, population growth rates far exceeded the national population growth rate.
That's right. And, another thing is that the majority of the population there are still renters. So if you pull up the statistics on this, you'll see that I think about 52% of people rent in this area. So there's a lot of demand for that. It's also a fast-growing younger population. So there, a lot of areas right now where we're seeing growth, it's, baby boomers and older generations. This area, there's a very young population, which we tend to see renting as opposed to purchasing as well.
Okay, we're talking specifically about Utah. Within the Intermountain West, Utah has long been one of the fastest growing U.S. states, and that's really for a couple different reasons. Oftentimes in the United States, when you see higher than average growth rates in a certain state or in a certain metro, that's due to in-migration. Oftentimes it's domestic in-migration. But in addition to that, in a lot of Utah counties, it's that birth rates far exceed death rates, as well as having net in-migration. And really, that just comes down to the fact that Mormons have a lot of children. So that's part of the population growth.
Yeah, that's exactly right. And so one of the things that we'd like to see in this area is there is a lot of construction, but what there's not a lot of are new construction fourplexes, which is exactly what this provider offers. So this provider that we're going to talk to on the webinar live this Wednesday, they have approximately, I think, about 15 years of producing, these high quality new construction properties, also in managing them as well. And so they have the track record that kind of backs up what we're going to tell you all about next Wednesday. And we're excited to share some more details with you at that time, but we will touch on some things today. So I mentioned these are fourplexes that are going to be available for purchase. We will have the opportunity for you to actually put a contract on them and buy them right during the webinar, right after the webinar. So they are going to be available. So some of the things that I personally like, not only do we mention this new construction, so you're not going to have to spend a lot of money on, typical CapEx type items. You're going to have, brand new everything pretty much in there. There are a lot of really nice amenities. They don't skimp on the amenities in this community. So you're going to have your granite countertops. You're going to have stainless steel appliances. You're going to have luxury vinyl throughout the home. One of the things I really like too, and when I was a renter not that long ago, maybe 6-7 years ago, I really looked for was, hey, what can I do outside of the community if I'm not spending my time in my unit? And so some of the amenities they have in this community include a fitness area. So you're going to have a gym that the renters can go to. They're going to have a playground for the kiddos. And my personal favorite, because you know how much I like animals, is they also have a dog park. You don't see that in a lot of new construction at the moment.
Oh, well, you put a lot there. Yes, with a lot of these amenities in this new construction fourplex development, you're talking about like a dog park and like a clubhouse, in addition to the in-unit amenities that you mentioned, like granite counters and stainless steel appliances. These are the sort of amenities that promote long-term tenant retention, tenants wanting to renew their leases and stay a while. When they're the first tenant in a place, it kind of feels like their own. Of course, we're talking about fourplexes that are built what I call townhouse style, side by side. I don't even know if anyone still builds the old up and down style fourplex where all four tenants would go through the same common entrance to the outdoors. Do you even see those be built anymore, Aundrea? I haven't heard of any new builds done in that style in a long time.
It's certainly unusual to see that at the moment.
Right. People want their own individuality in their own garage. These come with garages as well. And that way, again, it feels like their own for the tenant, aiding in that tenant retention. And specifically, the area that we're talking about is Ogden, Utah. It's about a 35-minute drive north of Salt Lake City. And the census defines it, they call it the Ogden-Clearfield MSA. Seems like the Census Bureau is always trying to hyphenate the names of their MSAs. And it does have a substantial ballast, a population of over 500,000 people and growing fast in that MSA. We're talking about new construction fourplexes. I think this solves a lot of problems. First of all, there's more investor demand for it, where you can tie up 4 doors with just one loan. And it also helps solve this housing supply crisis we've had in the United States, like I talk about so much. Opening up and building in areas where regulations allow, where you can have more dense housing with proximity to jobs. So this really solves a lot of problems.
That's exactly right. A few of the things that we'll get further into depth on the webinar, and we have a lot of details to offer you all. We can show you examples of what these are going to look like, renderings, that type of thing. But these are higher price units, but they still cash flow. So we're going to go really dive into the numbers on the webinar so you can see exactly what that cash flow is, what the return on investment is, the cap rate. You'll get to see how big the units are, so we'll talk about that as well. And one of the things that we're going to talk about is you're buying these already with some equity in them. They actually are appraising higher than what you're purchasing. So That's a big benefit to those.
This is really the opportunity for you, if you want a higher purchase price and you want to borrow and leverage more dollars where inflation should debase that larger debt amount for you over time. Of course, this comes along with a built-in management solution for the investor.
It does, yes. So they have management. They're a very experienced management company. We have heard nothing but good things for the GRE listeners that have purchased through them and have renters that rent through them. So we're really excited to talk more about the property management next week as well.
And that manager is probably going to be able to attract a pretty good quality of tenant. Median incomes in the area are strong, as well as the job growth and just the type of place that a new build property attracts. You tend to get a better quality tenant as well. Now, I know what you might be thinking in your mind's eye, you, the listener. Oftentimes when a whole bunch of fourplexes are built in an area, after, say, 10 years, the area can get looking pretty ratty if things aren't attended to here while we're talking about the activity that the property manager is performing for you over time. I would know. I came from the fourplex world. I think you all know my story, how the first ever property I owned of any kind was a fourplex unit where I lived in one and rented out the other three. When I bought that property, all the buildings in that area were about 20 years old. And it started looking pretty ratty and buildings were painted different colors and some of the paint had faded and everyone had a dumpster out front with trash strewn here and there. And it was just kind of a fourplex neighborhood where things had somewhat degraded aesthetically over time, and that really began to affect the quality of tenant that could be attracted there. But here, there is an HOA, and sometimes that can be a bad word in the rental property investing world, but this really helps keep with uniformity and cleanliness. This is really integrated, this HOA, with a long-term vision for attracting good tenants and maintaining your property values over time, more of which you can learn about on the webinar. But there's really a long-term vision here for you as an investor, since this should be thought of as a long-term investment.
That's right. And that HOA and the property management company, there's over 4,000 units across all of their properties. And I personally have not heard anything negative about any of their communities so far, which is pretty impressive because that's a hard track rate for 15 years.
So an opportunity, again, to get new build fourplexes in a really fast growth area with cash flow, actually, which oftentimes you don't get with new build properties. What else can you tell us about the market, the properties in the event, Aundrea?
I want to spend most of the time next week focused on that. So we'll go into a little bit more details, but overall highlights from the conversation. They're very nice new construction properties, lots of amenities, cash flow, as well as you're buying already with some equity in there. So we'll dive into all of that a little bit more when we have the webinar.
Yeah, so it is going to be you and the provider. And you mentioned it, Aundrea. This is a proven provider. They provided 4,000 doors in the last decade, and they specifically know what investors need. So join the event, this appeal of new build properties in a fast growth area, tying up 4 rental doors with 1 loan. It's going to be Aundrea and the provider. And the benefit of you attending live from the comfort of your own home is that you get to ask questions and you get to have your questions answered in real time. It's coming up in just 2 days, Wednesday the 16th at 8 p.m. Eastern. It's free to attend, and it is good, timely, granular information, as well as a buying opportunity if you so choose. Register right now at grewebinars.com. Any last thoughts leading up to Wednesday's event, Aundrea?
No, but I'm really excited to see all of our listeners on and be able to interact and answer any questions you all have and hopefully get you some cash flow and properties under contract.
Aundrea, great informative event here. Thanks so much for sharing your expertise with our audience today.
Thank you, Keith.
Aundrea talked about cash flow. Okay, that exists and great. Yet I still think of these as better for appreciation than cash flow over time. She'd probably agree. Maybe you're thinking a brand new construction fourplex in Path of Progress, the Intermountain West, that could cost $1 million or $2 million, but no, this builder provides them for less than that. And then, of course, you're probably going to finance most of that cost as well. And by the way, Aundrea did smile at my dorky joke about her loving rap music. A big smile that you couldn't see through the audio-only podcast here. But yeah, you didn't quite hear a laugh. See, one prerequisite to laughing is that a joke actually be funny. In any case, Aundrea and the Provider are your two co-hosts on Wednesday, and the Provider is a real powerhouse of knowledge about not just real estate and demographics and fourplexes, but construction and financing too, and everything that goes into it in order to optimize the investor experience for you. He can answer questions in real time for you. That's the benefit of an event like this. It is almost time for the Beehive State to shine as Utah is front, center, and under the stage lights on GRE's live event in just 2 days. You are cordially invited to join, I guess as long as you don't ask Aundrea about rap music. But really, when you put this all together, a 4-unit building, it's the most you can get with the best financing terms, the cash flow, new construction, often this built-in equity at purchase time too, a fast population growth market, all of this inside a demographic population in Utah that's young and has good incomes. It's really quite remarkable, quite a confluence. We haven't had an event for a product type like this before, and I don't know if we'll ever have an event quite like this again. Attend live to get your questions answered and get the first look at the inventory. But if you can't make it on Wednesday, then sign up anyway, and we will effort to get the replay link for you. You can do it all at grewebinars.com. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.